Hi, this is Steve Hutchinson with Hutchinson Family Offices, and here we are for our regular monthly video. It's a little later in October this year than we have. We're going to take a look back. We're going to talk about some of the challenges we believe that the economy is facing and what impact it may have on your financial assets or your financial future. And this is something is very important for us to discuss in as much detail as possible as time allows. There's been a couple questions about my choice of beverage. I drink Monster, sugar-free of course, but there's three colors here: red, blue, and white. This month I'm selecting blue. Blue would signify my attitude about the financial markets. I think they're starting to cool down a little bit. Although you're seeing a lot of volatility, you're not seeing much headway in the financial markets. And this is, our reasons for this are pretty straightforward, or my logic behind this. First, I want to deal with the Fed. It's well known that if you're going to be an investor in the financial markets, there's two things you never do. You never fight the Federal Reserve. If the Federal Reserve is loosening monetary policy, then you go along with them because financial markets like that. And then if you like, and then the other thing is don't fight the tape. If the market's going down, don't try to catch a falling knife, or if the market's going up, you ride it. So right now, we're having some problems with the Fed, or the Fed's having its own set of problems. Simply put, the Fed has two primary objectives. I don't care what they say in Congress or when they're being interviewed. The Fed's primary focus is inflation and employment. That's their number one thing. We've got two problems going on here at the same time. Now, I have not been a big advocate of transitory inflation. I believe that inflation is not driven by demand as much as it is driven by supply. And that might be, maybe that's because I'm a supply side individual, but bottom line is the supply will eventually meet demand or exceed demand. Well, today we have supply is falling below demand. We have greater demand for product, goods, and services than we have that's out there. Case in point, we have a bottleneck on the West Coast with shipping containers from all over the world can't get in to dump their product. Quite frankly, the Transportation Secretary, he's not done a very good job. I don't think he could organize a one-car funeral train, but quite frankly, this is an issue that really concerns us. As supplies or supply constraints start to manifest themselves, demand doesn't disappear, demand continues, and then what happens is we have what's known as inventory inflation. It's much like this. Say you're buying gasoline from a gas station, and the gas station owner takes in 5,000 gallons of regular gasoline that he paid $2.50 a gallon wholesale. Then the next day or the next week, before he burns through that inventory, the price goes up on the wholesale level to $2.75. Well, we all know he's going to have to raise his prices at the pump, or he ain't going to be able to afford the gas on the next load in. And that's what we call inventory inflation. And we're having a lot of inventory inflation now that's being created by supply. And that's something that we have to understand. So inflation is here to stay. It's not transitory. And we're hoping that the supply will at least move up a little bit, or move up significantly to offset some of the increased demand. There's very little the government can do, I'm speaking of the federal government, to increase supply or change the road of inflation. In fact, most of what the government is doing right now by putting more money into the system is creating greater demand for goods and services. As a result, those goods and services are in higher demand and supply constraints are hitting us. So it's very clear to see that we've got two forces in our government that are working against each other. The other thing about inflation that concerns me is wage inflation. I'm an advocate of someone making a good wage. I mean, don't misunderstand me. But at some particular point, and we're starting to see it now, wage inflation or wage increases are starting to filter through the market. Yes, there's a lot of jobs out there. There are a lot of people looking for employers trying to get their businesses back up to 100%. but the wage increases that we're seeing are quite significant. In fact, I think numbers I've read are 5 to 6% year over year. So this is going to be an inflationary effect in itself. So again, wage inflation is here. That does concern me with the Fed. So here's the Fed trying to manage inflation. What do? And then at the same time, we're seeing stagnant job growth. I've got the unemployment report in front of me that came out this month. And basically, we are looking at somewhere in the neighborhood of 194,000 jobs in September. That's mediocre. That's nothing. 194,000 jobs in a country as large as ours is not very much at all, okay? So we got the Fed, they're dealing with inflation, they're dealing with a slow job market, and at the same time, they're pumping $120 billion a month in bond buys. And you hear a lot about this. And early on in my videos, I was talking about big buzzwords going to be taper. When's they going to quit buying? Well, here's what happens. The Fed quits buying, so bond prices start rising. As a result, and which means, interest rates start rising, and we find ourselves in a paradox here. So these look kind of bluish for the market, if you will. And those are things that concern me right now. The second thing is they don't have control over inflation. Chairman Powell got everybody all excited about saying, well, it's a transitory. Chairman Powell doesn't have any more of a crystal ball than anyone else you know. He may be a very well-educated Federal Reserve Board governor, but quite frankly, they didn't even know what to expect. And now they're getting caught on the opposite side of this, and they're realizing, hey, this inflation isn't as transitory as we thought it was going to be. So these are two issues I think that are going to affect the market directly and are going to affect you individually. We're going to see stronger inflation, bigger increases in goods and services. I told some of my good friends and family and stuff, I said, hey, look, guys, you better start looking at electric cars. Gasoline's not going down anytime soon. Gasoline prices are where they're going to be. They're going to be much higher in the future. And then we're going to see goods and services. Hopefully they can get the supply chain open. But you got to remember, the only thing that's sitting off the coast of California is maybe some furniture and the G.I. Joe with the Kung Fu grip. What we need in this country is solid supply chains that come in, and we're not getting that right now. So the markets, as a result, are probably going to move sideways, and they did move sideways for the last 30 to 45 days. You see some good days, some bad days, but for the most part, markets, I expect them to move sideways. The market focuses, the financial markets are asset managers like ourselves. We focus on earnings of a company. And what we're looking for is we're looking at sustainable, growing earnings. We want to see the earnings are sustainable, and we want to see that they're going to grow over a period of time. In some cases, we're seeing that. In some companies, we're kind of scratching our head. We're wondering how are they going to be able to sustain these growth rates in their revenues, or if you will, in their sales. So we are a little bit concerned about the softness we may see in the financial markets. Now, in the past, it's always been, well, let's go to bonds. And the bottom line is bonds have no real return at this particular point. We've looked at portfolios that other advisors have recommended to clients that have relationships outside our firms, and we have found that most of those clients don't realize that they're paying top dollar premiums. I mean, a $200,000 bond, they're paying $220 just to get that income. And quite frankly, they're overpaying for bonds now. So bond yields aren't going to be the safe escape. What we believe is the economy is going through a cycle. This particular cycle will open up the door for opportunities in outside what we call alternative investments. We're very comfortable with the portfolio of alternatives that we have. And then we're also very comfortable with some of the debt levels that we've taken on. And when I say debt levels, I mean the type of debt we've taken on, that we are not staying in AAA because there's just no money in it. So we're looking at more structured notes and different things like that enable us to get a much better return. So overall, we feel very, very positive about a lot of things, but not when it comes to the economy. Are we heading into a recession? That remains to be seen. Although I think we're a ways from it. I don't expect that at this point based on the numbers that I read. But I do believe there's the possibility that in the first quarter, second quarter of next year, we could see this economy slowing down quite a bit, particularly since the Fed has already identified that they're going to increase interest rates at least 1 or 2 times. And everybody's speculating on when they'll do it and how they'll do it. But we don't know how they're going to pull this off. With an $8 trillion plus balance sheet, they're trying to taper bonds. We don't really know how they're going to do it because, quite frankly, inflation is the number one thing they're supposed to keep under control, and that means they got to raise interest rates somewhere. So we'll see what happens. As far as what we're concerned, we're buying companies that we believe that are high quality, have solid and sustainable earnings. We look at them very closely, we watch them very carefully on a daily basis, and we look at the return projections that we feel that's reasonable. Overall, I think that we maintain the course, we stay where we're at, and we focus on quality, and as a result of that, we have to look at some of the supply issues that are going to start affecting some companies. That's what I offered today. In this video, I want to point out that as we travel through this market, some days it's going to look really good, some days it's not going to look so good. Bottom line is I think it's important for you to speak to your advisor directly. And, sticking your head in the sand is not a solution. We need to adapt your portfolio for the level of volatility, or not risk. People throw the word risk around a lot. I'm not a big risk fan. I like volatility. We have to adapt it to the level of volatility that you feel comfortable with. Now, realizing that your long-term financial goals may hinge on you having a little bit more volatility. And of course, we never time the financial markets. So in general, I think inflation is here to stay. I believe it's real. We have a lot of inventory inflation that's coming into the situation. The last 3 months in job growth have been even less than disappointing. I mean, really, I don't see how you can spin. When I read through the labor report, I don't see how anybody can spin that as a positive thing. We see the financial markets maybe sideways. We all hope for a better one, but I think sideways would be what we get as earnings come in. This quarter, we'll see what the comparables are. And then, of course, I want to point out that bonds are not a safe alternative at this point. In fact, that might be the one area that you could see principal loss the quickest. That'll do it for this month's video. I hope I didn't bust your balloon, but bottom line is my job is to deal with this information straightforward with you and tell you exactly what we believe is going on. Have a great